opening slide for today's video is about the car market. I'm going to cover a piece of that, but I'm also going to cover other aspects of the economy, what's going on. I will say this, the economy is slowly sinking, going down and down and down. And a lot of that is being tied to the consumer. The consumer is being squeezed big time. This doesn't mean that the market or the economy is going to crash tomorrow. I don't think that's the case. But it does say that there's a weakening going on, and at some point, there's got to be a reconciliation. There's got to be some kind of a reset. And it's in our future. Is it a year or two or three from now? I don't know. But I'm not trying to be negative for today, but I'm saying get prepared for tomorrow, because in my opinion, it's coming. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is May 7th, 2024. As I said, I'm going to begin with this piece. And by the way, thank you to my friend Kyle who sent me the link on this. This is a piece about the car market. I don't want to focus on the car market. That's not where I want to focus my time. What I want to say is that and other indicators I'm looking at are say to me, the market for goods and services, the economy is sliding down and down and down. This is more of a macro view, so that therefore I don't say it is imminent, but it's coming. Maybe it is imminent, but it's not immediate, I should say it that way. But it's coming. And the reason I'm telling you this, because those who follow my channel and who I read, they leave comments, and people I talk to, I can tell they're serious investors. And I think, some are clients actually, and we manage their money, and we have a method to deal with this. But a lot of them are traditional investors. They're buy and hold investors, and they're nervous. They're getting more and more nervous, more and more concerned, because they see what I'm seeing and talking about is that there's coming a point. It's been, 15 years or so, but there is coming a point where a major collapse will happen. It has to happen, because when you go this far in a bull market off of a bottom, eventually it runs out of steam. Prices are overstated. Companies are overvalued right now. The market is overvalued. And what that means is it's got a lot more downside than it has upside. This was interesting to me because it's something we can all relate to. America loves cars. And guys, and women too, but guys really love cars. And so it's so much a part of our economy, the automobile. And so I'm going to play a clip for you. It's about 2.5 minutes from a guy. He's a car guy. He owns a car independent dealership is what they call them. You and I call them used car lots, but it's not a lot. It's a big business. It looks to me as he walks around that he's got about 100 cars, maybe more. So it's a big business. It's a pretty good sized business. Not your typical car lot, but he is kind of a car salesman guy. So you'll have to I didn't like his style because it was very car salesman-like, but he did a good piece on this, and that's why I'm playing it. So I'm just asking you to kind of close one eye when you look at his style. But his information is correct. And what he's saying is that and he's giving a lot of evidence for it, the car market is collapsing. And you can see it with the dealerships, and you can see it with the used cars as well, is that there's a lot of sellers and not many buyers. The average car payment, I'm assuming most of these are new, but average car payment is $750. Wow, that's a lot. And there are cars and trucks that go over $1,000 a month. And some of these are being stretched out to 5 and 6 and 7 years of payments in order so that people can even pay that much. What's happening with the used car market is coming out of the new car market, but what's happening, I read it more than one place, is that people are buying them because they're enticed, because it's nice to drive a new truck or a new car. I admit that. I drive an old truck, but you know, I understand the appeal of a new truck or a new car. But when people get used to, okay, and now I'm used to it, and then the payments start hitting $750 or $1,000 or more per month, that's choking out food, rent or mortgage, and other utilities, other things that people have to pay for. What people are doing is they're taking the keys and handing them back to the dealership and saying, I can't afford it, and walking away. They'll take rather than go bankrupt, their credit will be trashed. They call that, I don't think he says it in this segment of the video, but I read something where it's called voluntary repossessions, where they're handing the keys back and saying, I can't afford it. What's happening is the cars are piling up. Now it's a used car or used truck. And if there's anything wrong with them, and sometimes there are because people trash them before they turn them in, then nobody wants them. And he goes over that. So it's a swelling market on the new car side and on the used car side. That to me is an indicator. And there are other indicators that what's happening is below the surface of our economy, there are cracks appearing. And again, this is deferred. So it may push out a year or two or three, but it's coming. Because if this is happening now, what's it going to be like a year from now and 2 years? It's going to be more and more and more, because the companies they want to sell vehicles or whatever they're trying to sell, and people are enticed to buy them, but they can't afford them. So there were some other indicators, and I wanted to go through these with you, and then I'll play his clip. But the car market, which he articulates well, so you can listen to that. The second thing, I listen to this and I take it in and I think, okay, what is this telling me? My daughter, one of my daughters, she works in the technology industry. She's a data scientist. She got her master's degree in data science from a major university, and she's paid well, and she works for a major company. I won't say who it is. And she doesn't like her job. Whatever's going on, she doesn't like it. And so she's been there a number of years. So she's putting her resume out. Normally, if you go back a couple of years, 2 or 3 years, she would be getting calls constantly from recruiters for this job and that job, and more money. What's happening now is there are no calls from recruiters. She put her resume, which is an impressive resume, she put it out to 70 companies, 70 technology companies that are looking probably or somewhat in the data science field. No calls from 70, highly qualified. She did a little more digging, and her information tells her, I don't think this is fact, but it's her impression, that these companies are posting jobs that don't exist. They want to give the appearance that they are growing and they're looking for people, but they're phony jobs. They're not real. So she's applying for a non-existent job. 70 of them. So, and they're apparently all doing it. But, well, that's basically a lie, but that they're posting these non-existent jobs. But what it tells you is there's the appearance, and you can look at stock price too, there's the appearance that these companies are doing well, and they're not doing well. They're laying off people. So she's applying into companies where they're doing layoffs. They're not hiring anybody. They're laying people off. One after another after another. Indicator number 2. Indicator number 3. My son, one of my sons, Preston, works in the Bay Area. He's in the precious metal business. I've mentioned it before. And so So the spot price of gold and silver is going up and up and up. Okay, it's been increasing. The markup, the premium, the commission on it has come down and down and down. 2.5 years ago, what was the markup on silver? About $5 an ounce. Ridiculous. So much so that some people said, I'm not going to pay that. It's down now. I think today, I think Friday, it was $1.23. $1.23. I don't know. I think it got down to $1.10 or something. From $5, come all the way down. So I said to him, Preston, what's going on? There people, aren't they kind of beating down your door because the spot price is going up and the markup is going down? He said, no, Dad, that's not the case. We have people who are wealthy, who are buying large orders. That's one thing. But the average buyer is not showing up. I said, really? With a $1.23 markup, it might have been $1.10 when I made this statement to him. That kind of markup, very low. That's about as low as I've ever paid for silver markup. And he said, they don't have any money. Nobody's got money. And so it's, yeah, we have a customer here and there, but they're not beating down the door. And he said, it's not just here, it's everywhere. So what's interesting is they're charging more and more, which usually is an indication people want to get in, and the markup coming down, that would be a recipe for high sales. When it was $5, people were clamoring to get in. Now it's $1 something, and they're not because they don't have money. And he said, Dad, they've lost their jobs or they fear losing their jobs. It's a weak economy, and he's in the Bay Area. He's in a wealthier type area. And he said, not happening. That's indicator number 3. Number 4, one of the big pieces of news over the weekend was Berkshire Hathaway had their annual shareholder meeting. So people fly into Omaha, quite a few of them fly in on their private jets for the meeting. And it used to be Charlie Munger and Warren Buffett. Now it's just Warren Buffett because Charlie died this past year. And people follow this. They come to the shareholder meeting, or they follow his letter to shareholders, or whatever. It's definitely a financial event that people are interested in. And in the meeting, Warren Buffett said, and he gave a warning that the economy is in trouble. I don't remember the exact words, but that's a paraphrase. They are sitting on $189 billion. Several years ago, I remember tracking this when it was just above 100 billion, 110 or 15 billion, and it's gone up every year, year after year. Why is that? Warren Buffett wants to make money for his shareholders. He is a value buyer, so he buys companies or pieces of companies when they are attractively priced. He's done that for, how long? 60, 70 years. His opinion is there are no companies that are attractive to him to buy at these prices. So the prices keep going higher and higher. He's piling up cash to buy, but he doesn't want to pay these elevated prices. This is indicator number 4. That the market is overheated, prices are overvalued, and somebody as smart as Warren Buffett says, I'd rather sit back and collect my 5% money market or wherever he's got his money. But he gets a lot of flack from investors because why don't you invest the money? And he says, there's nothing I want to buy at these prices. So what he's saying is, this is from a stock market perspective. The rest I've been talking about is the economy. But from a stock market perspective, what he's saying is the stock market has got to come way down for me to be ready to buy. I will buy, but I'm going to wait for that correction. Maybe it's a crash. I don't know what his indicator is, but it's a long, long ways from where it is right now. So what I'm saying to you is this: I take these 4 indicators and I put them together, including the car market. That's just one. I take those together and say to you, get ready. Have a defensive strategy, whatever it is. Whether you're a buy and hold investor, he has his method, I have my method, other people have their method. And my goal is I can't eliminate 100% of the loss, but my goal is to eliminate a lot of it, most of it. That's my goal. And so I've designed my approach, my defensive approach to do that. Whatever method you have, all I'm saying to you is think about defense. Maybe you don't need it today. I don't know, because I don't know the future. But I can tell you that these are all indicators that say we're in store for, at some point, a major correction. And it will be, as you look back on the last 1 or 2 or 4 or whatever, Warren Buffett lost 50% of his money 4 times, about 50% 4 times. And so he knows what this is about. The average investor who does not have that kind of money cannot afford those kind of losses. And all I'm saying is, think about it. Have a strategy, whatever it is that you feel comfortable with, and be prepared for a major correction, or we could call it a collapse, or we could call it a crash. But I believe that it's in our future. I don't think it is too many years ahead of us. So with all that, thank you for bearing with me. I'm going to play this clip. It's about 2.5 minutes. It's kind of, it's by a car salesman, so bear with it. But I think he's telling a message here that is saying something to me that I just told you. So take a listen.
This truck is $85,000. This truck is $90,000. And I'm a used car dealer, and here at these car auctions, we're seeing auto loan delinquencies and repossessions spike.
Hey, what's up, guys? John here. Tens of millions of Americans are opting out of car ownership, giving the keys back to the lender. They can no longer afford these payments.
Americans now falling behind on their car payments.
The average monthly payment for a new vehicle right now is $750.
Oh no, $47,000 for this little unit.
Where are they going to put them? Where? There's nowhere. No empty spaces. It is full to the brim.
And look, $85,000, that's getting out of hand.
And the consumer right now, with everything costing so much, they are not able to keep up with their payments. So what happens? They lose their cars.
These are the places that you're not going to hear about on the mainstream media, but are just completely going out of business. And by default, those people lose their jobs.
And if you're wanting to buy one of these big SUVs or nice trucks right now, it's not going to be anywhere close to $750 a month. You're going to have to pay way more than that.
$118,000, folks, 118 grand. Wow, no words. Clearly the market is broken.
This truck right here is $96,000. So check this out. This is a full row of $80,000 and $90,000 F-150s.
That is getting out of hand.
There are so many auto loan delinquencies in the system right now that there are not enough tow truck drivers to service all of these lending institutions to get their cars back. And repossessed cars are the worst of the worst. They're dirty, they're nasty, they have parts falling off of them because the consumer knows if they're going to lose their car, why take care of it?
And I personally think we're going to walk into the biggest auto loan and auto market crisis we have ever before seen.
The other big thing I'm noticing at the moment is just seeing big dealerships disappearing. As soon as the values of cars came down, there just isn't the money left there anymore, and they're all defaulting and having to go through a bankruptcy.
So prices are so high that consumers are having to push out their loans to 72, 84 months to even be able to afford any of these vehicles.
But look, this is a Wrangler 4-door Sport 4x4, $66,000. That's absolutely lunacy. Clearly the whole Canadian market is upside down. Vehicles are not selling. There's way too much inventory.
Ford Mavericks that you couldn't find anywhere. Look behind me. There are 9 of them sitting here for sale. Dealerships, even the Ford Maverick, stuff that was so hot that you couldn't find anywhere, is still right now sitting on dealership lots, not selling.
Okay, next I want to shift gears here. So I want to go over, and I'll go through the internet and I try to find information that I think I'm interested in, therefore I think you'd be interested in. This is about China, and it is a credible piece being done by CNBC. So this is not a blog, this is CNBC. And they're saying more cracks are appearing below the surface and China's economy is in trouble. Now the reason I mention this, bring this up, because okay, we don't live in China. You may think that doesn't relate to me. I care, but it doesn't relate to me. But China is the second largest economy in the world, second to the United States. As China goes, so goes the world. As the United States goes, so goes the world. So the world is very intricately interwoven, including us and including China and, of course, Europe and the UK, et cetera. So for that extent, I thought it was credible. Again, like I said a few minutes ago, I don't think this is tomorrow. I think it's not going to happen tomorrow, but I think it's in our future. China has a lot of trouble, and it seems to be getting worse. So take a listen to this piece.
Chinese population has declined for the first time in decades. It is a big deal because it marks the end of this era of rapid growth and of cheap labor.
China's ghost cities, or residential buildings without tenants or construction that never finish, have become visual metaphors for the ongoing crisis.
Demand disappeared, there was lack of trust among buyers, and that's ultimately what led to decline in demand and therefore the downward adjustment of prices as well.
Since the end of 2022, China's urban youth unemployment rate has risen to 21%.
This is an age category from people 16 to 24, about 96 million people, the Statistics Bureau said. 6 million of those are still looking for jobs.
The second largest economy in the world is in trouble. China is facing a growing list of problems: real estate, semiconductor bans, and labor market gyrations. The world's second most populous country also has a major youth unemployment problem.
Really quite disconcerting was the youth unemployment figure. It hit a fresh record of 20.8% for May.
That's up from 20.4 the prior month. This is an age category from people 16 to 24, about 96 million people, the Statistics Bureau said. 6 million of those are still looking for jobs.
Since the end of 2022, China's urban youth unemployment rate has risen to 21%. The issue was getting so much attention that China decided to stop publishing the data altogether. China's youth employment rate now ranks with several G7 countries that have notorious problems with getting younger workers into the labor market, like Spain and Italy. India, the world's most populated country, has also been dealing with a youth employment problem. But China has prided itself on putting its hundreds of millions of younger, well-educated citizens to work, and the most recent data set a record for the highest youth unemployment rate ever in China.
It's been a while since I've played a piece from Mike Wilson. He's been kind of quiet. And he is very focused, he and Morgan Stanley are very focused on the earnings as an indicator for growth in stocks or a contraction in stocks. And he is considered by his peers on Wall Street, he's voted a number of years in a row, I forget how many years in a row, as the most valued portfolio manager on Wall Street. That's a huge, there are very smart people there. And that's quite an accomplishment. And so they see what he does right and what he does wrong, and he often admits, hey, I got this wrong, I got this, and they say, oh, you got this right, okay, whatever. But he's credible. So he is saying, as he always does, he's coming back to earnings. Earnings are coming down, and what's happening is not just the earnings, but the multiple on earnings. So a company's value, let's just say the price of the stock, is a function primarily of two things. One is the earnings of that company, and the other is the multiple times those earnings that creates a value. And so, but it's the multiple that seems to be coming down. So I think he does a good job of explaining this. So take a listen to Mike Wilson.
We begin with our top story. Stocks higher after the S&P 500 snaps a six-day losing streak. Morgan Stanley's Mike Wilson saying this: we believe equity markets have been trading poorly in April, primarily due to the repricing of Fed cuts. With 10-year yields now well above our key 435, 440 target, stock appreciation from here would largely have to be earned through earnings upside rather than multiple expansion. Mike, I'm pleased to say, is with us around the table. Mike, good morning to you.
Good morning.
How high is the bar or low for those tech firms through this week?
Well, it's mixed, as you were saying. It's not all one trade anymore. It's sort of the magnificent 3 or 4. Some are falling by the wayside for fundamental reasons. Some are falling by the wayside for rate reasons. And look, they've got tougher comparisons now. So I think that, look, it's always the case, right? It's not so much about the earnings results. It's about the reaction of the stock to the earnings results. And I think that's what I'm really fascinated to see, how much goodness is already priced into even the winners. And there are some big winners in that group. I agree with you, Lisa. I think what's more interesting is what's going on away from those stocks. That will inform us more about what's actually happening in the economy, you know, what the expectations are around Fed, for example, and also some of the geopolitical risk, which I think, you know, that's not our number one concern, but it's also one of the reasons we're overweight energy.
You said we can learn something from the earnings themselves and how the stock responds to them. What have we learned so far as we get deeper into earnings season?
Well, it's about 50-50. So 50% have been up, T plus 1, 50% have been down. That's worse than normal. This is in line with what we've been saying for quite a while now, as we think now we're in a period of multiple contraction, right? If you think about the last 6 months, all that really happened was, you know, the Fed pivoted, Treasury, I would argue, sort of squeezed the bond market. We had a duration rally into year end, and that affected a huge multiple expansion. You know, it doesn't get a lot of press, but 2024 estimates for the S&P 500 haven't really gone up, okay? They've been sort of flat over that 6-month period. It's all multiple expansion. So our call basically is that first of all, we thought 7 cuts was silly. I think a lot of people agreed with that. And now we're down to 1.5. So why wouldn't multiples come down in that environment? And I think that's what we're facing now during earnings season, is you've got to really put up a serious beat and a revision to the upside for the stock to go up. I'm very curious to see how that plays through the next 2 weeks.
What we're seeing right now in the earnings is not a cohesive story. I mean, honestly, you're seeing some areas where it's cost cutting that's keeping margins afloat, and other areas where you see, you know, for example, demand for trucks in the U.S. going gangbusters. Are you seeing any themes that you can kind of grab onto so far?
The theme is that it's a very unbalanced economy, and that's the theme we've had for a while. So post-COVID, it's just been a very unpredictable environment for a lot of reasons. Some of those things we got really right, some of those things we got really wrong. And I think we're trying to figure out kind of what the next stage is. Let's look at the last year as an example. So a year ago, hard landing, recession was the consensus view. Market overpriced that. Then we got a soft landing priced in 2Q. Then we had a sort of a fiscal sustainability problem where growth got too hot and rates went up and we had a big correction. Then we went back to the soft landing, and now we're in no landing. So this is our view at the beginning of the year. It's like there's a 33% chance of all 3 of those happening. Soft landing, no landing, hard landing. And I think it's the same. So in other words, right now we're trying to price that no landing scenario, but I'm not confident that we're going to stay in that environment. And companies are a reflection of that, right? Some companies do better in that scenario. That's why they're doing better, things like energy, materials, financials. But is that sustainable? We're going to find out.
You know,
next, I want to play a piece by Mohammed El-Erian. It's also been a while since I've shown you something from him. So, and of course, I have a very high opinion of Mohammed El-Erian. And so he talks about the labor market. This is a very brief piece, but he talks about the labor market being okay, and it is okay. So you look at the job creation, the unemployment. Things look, I won't say they look strong, but they look reasonably healthy. But he says there are other signs of a slowing economy. He says, look at Starbucks, McDonald's, Pepsi, Nestle, and some of these are like for you get to Pepsi and Nestle, they own dozens of companies. So it's not just that one brand, it's that brand and all the other companies underneath them. They have a slowing in earnings, and it is showing up in the stock price. So once you get outside of the Magnificent Seven, or as Mike Wilson said, the Magnificent Four, or whatever it's come down to, you have below that, you have a weakening economy and a weakening earnings, even in major companies. So whether it's the car market, technology jobs, buyers of gold, they don't have money. People, the consumer is getting squeezed, and the consumer is 70% of our economy. 30% is corporate and government. 70% is a consumer, and the consumer is out of money. Credit card debt, we know, is going to higher and higher levels because why? Do they want credit card debt? No. They don't have any money. Where are they going to turn to? So These are all signs of cracks appearing below the surface. So take a listen to Mohammed El-Erian.
Bob, your thoughts on this one? As Michael McKee was reading through the commentary, I thought, boy, this is really good for the markets, because here is a Fed that's telling us, look at the longer term. Look where inflation was and look where we've gotten it to. Don't worry about the last couple of months. We'll see what happens there. I actually think that's the right message. I don't believe the law of long and variable lags has been repealed. I think they've been delayed because of all the fiscal stimulus that's still in the pipeline, but they're still there. You are seeing some pressures on the economy. Like Mohammed, the only thing I was surprised about is that they characterize the economy as still solid.
Yeah, look, Mohammed, I want to bring this up. I brought it up earlier with Bob Mike. I'm going to do it with you right now. I don't know where you were in 1995, maybe at the White House, Mohammed, maybe IMF. But the answer is Bob Michael says there's whispers here of 1995. The stock market was a moonshot off of the success of 1995. Is that what we are prepared for here, that they may get this right? We may have a constructive 1995 and up we go?
So where I agree with Bob, without any qualifications, is that this particular statement is something that the markets will like. It's exactly what the market wanted. As to, are we going to repeat 95 in terms of market reaction? Tom, what I'm worried about, because I truly believe that this is not about lags, that there are structural aspects that are running the equilibrium inflation rate higher than it has been in the past. I worry that the Fed is going to be over tight this year. I worry that the Fed is not going to end up cutting because they're going to be so data dependent, so reactive, that they're not going to look at the weakness that's coming. In fact, if you simply read the earnings reports of McDonald's, Starbucks, PepsiCo, Nestle, the list goes on, there is no doubt that low-income consumers are struggling. Their balance sheet effects have gone from positive to negatives. The pandemic savings are run down. Their credit card balances are high. They rely entirely on the labor market, entirely on wage income. And if something goes wrong in that labor market, we are going to see this economy slow much faster than anybody would like it to slow.
So one more piece. This is from Tiffany Wilding. She is the chief economist at PIMCO. And she makes a similar case that we have a decent labor market, but we have weakening companies below the surface. And it says to me, again, look out into the future, not too far down the road. What does this tell us? How are these companies going to improve their earnings, and how do you get the consumer more money to spend when they don't have it? Take a listen to Tiffany Wilding.
When you saw the softness in the labor market, it was pretty stark relative to what expectations were on consensus. When you see the weakening, what's the risk here that things weaken at a faster pace than people expect?
Yeah, so it's funny, when we look at the labor market data in more detail today, we actually see what was a still reasonably solid report, underlying all the bond market reaction today. If you look at some of the details, for example, government jobs, they actually have been quite strong. They were surprisingly weak, and that contributed to a decent amount of the miss. If you would add that back, when we think the data will get revised, the government can be a little bit sketchy in how they, how they report, and it does tend to get revised. Then this was actually a headline payroll number that was a little bit above 200K. And ultimately, we're still seeing, pretty solid trends. If you look on a 3-month moving average basis, we're above 250, right? We're a little under 250 on a 6-month moving average basis. So that's a labor market, that I would say is quite strong. So, there's not really, when we look around, there's not clear indications to us. Certainly things are slowing, they're moderating a little here. But certainly they're not falling off a cliff by any means. And if you look at the labor market data in the context of what has been very strong, growth in the United States, final domestic demand growth, which is a key indicator of what underlying demand is in the U.S., that's been growing at about 3%. which is above measures of potential. So I would say, if anything, when I look around, I still see a U.S. economy that's quite strong. I think that the bond market reaction today, if anything, was a story about positioning and a story about the fact that even though we have a strong economy, even though inflation's, is kind of getting stuck above target, that the Fed is a long way from hiking interest rates. They could still be delayed, and we do expect them to, to show us that they are going to be more delayed in cutting. But at the same time, they're really not prepared to hike at this point. And I think the bond market might have gotten a little bit over its skis in terms of pricing that. And that's why you're seeing that come out of yields today.
So I've made the case, tried to make the case through these videos, that the consumer is a big part of our economy and is an indicator. The lack of spending power that the consumer has, or the amount that they don't have, is an indication of things to come. Thank you for watching. If you have questions or comments, leave them in the comment section below.